Calculating minority rights in accounting. Minority rights in accounting refer to the financial interests and decision-making power held by shareholders who own less than 50% of a company's stock. Properly calculating and reporting these minority interests is crucial for accurate financial reporting and transparency. Understanding the concept of minority rights. Ownership percentage. Minority shareholders own less than 50% of a company's outstanding shares. Limited control. Minority shareholders have limited decision-making power compared to majority owners. Financial reporting. Minority interests must be properly accounted for and reported on financial statements. Identifying minority stakeholders in accounting. Shareholders. Individuals or entities that own less than 50% of a company's outstanding stock. Subsidiaries. When a parent company owns less than 100% of a subsidiary, the minority interest must be accounted for. Joint ventures. In a joint venture agreement, the ownership interests of each partner must be properly recognized. Determining ownership percentage of minority stakeholders. Shareholding analysis. Examine the company's shareholder registry to identify minority shareholders and their ownership percentages. Joint venture agreements. Refer to the joint venture contract to ascertain the ownership interests of each partner. Subsidiary ownership. Review corporate structure and ownership documentation to determine the parent company's stake in subsidiaries. Updating records. Regularly monitor and update minority ownership data as changes occur. Accounting for minority interests on the balance sheet. Recognize minority interest. Record the minority's proportionate share of the subsidiary's net assets as a liability on the parent company's balance sheet. Disclose separately. Present the minority interest as a separate line item under the equity section of the balance sheet. Adjust for changes. Update the minority interest account as the subsidiary's net assets fluctuate over time. Recognizing minority interests in the income statement. Net income allocation. The parent company's share of the subsidiary's net income is reported in the consolidated income statement. Separate disclosure. The minority's share of net income is reported as a separate line item, below the parent company's net income. Earnings per share. Minority interests are excluded when calculating the parent company's earnings per share. Navigating minority buyout scenarios. Buyout offer. The parent company may decide to purchase the minority's ownership stake. Fair value. The minority interest must be valued at fair market value during the buyout process. Equity adjustment. The parent company's equity account is adjusted to reflect the change in ownership after the buyout. Reporting minority interest changes in equity. Transaction. Impact on equity. Acquiring minority interest. Reduces minority interest and increases parent company's equity. Selling portion of subsidiary. Increases minority interest and decreases parent company's equity. Subsidiary net income, loss. Adjusts minority interest and parent company's retained earnings. Auditing minority interest transactions. Ownership documentation. Verify the accuracy of minority ownership percentages through shareholder registries and corporate records. Valuation methodology. Assess the reasonableness of fair value calculations used for minority interest buyouts. Accounting treatment. Ensure minority interests are properly recorded and disclosed in the financial statements. Internal controls. Evaluate the effectiveness of controls over the recognition and reporting of minority interests. Best practices for minority interest accounting. Transparency. Clearly disclose and explain the accounting treatment of minority interests in financial reports. Consistent monitoring. Regularly review and update minority ownership data to ensure accurate reporting. Strong controls. Implement robust internal controls to prevent errors or misrepresentations of minority interests.